Hey, everybody, we are going to talk about some companies that are so cheap that we have to kind of look twice. Tyler Crowe is joining me. Before we dive in, please take a minute, click subscribe, and check out the link you see on your screen for a message from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now, and it's the best way to support this work we're doing on YouTube. So I'll go first. The stock that I can't believe is still so cheap is PayPal. I get why PayPal got this cheap. If you remember, it pulled forward a ton of growth during the COVID pandemic. Essentially, management was saying this is going to last forever. They said they were going to scale up to 750 million users within the next couple of years. That should have already happened according to the original projections. And they were saying they were going to get to a billion soon after that. And it kind of stagnated in the low 400 million range. It's still impressive for one platform to have over 400 million users. But when you promise, 50% growth within the next few years and it's not going to happen, there are a few more reliable ways to tank a stock, especially if the company's profitable. So right now, PayPal trades for about $63 a share. That is less than 12 times its forward earnings. It's priced for essentially no growth. The company, as I mentioned, still has about 430 million active users, and management's strategy has basically been to focus on the customers that mean the most to its business. So growth is still happening because of this strategy. The user base is not growing. The user base actually lost 2 million users over the past year, but total payment volume is up 15% despite the lower user base because they're doubling down on their most engaged users. Revenue is still growing. Revenue grew 8% year over year, which not fantastic, not what it was doing a couple years ago, but more than a 12x multiple of earnings would suggest, especially for a company that has a positive net cash position. PayPal has $11.5 billion of cash on its balance sheet that it can invest in whatever business opportunities it sees. It has just over $10.5 billion in debt, so net cash position. It's generating roughly $5 billion of free cash flow annually. That's, it's generating a massive free cash flow. Most of it's going toward buyback right now. Management thinks the stock is cheap. They're essentially plowing every penny of cash flow into buybacks right now. I wish they would find something else better to do with it, I have to say. But I can't be mad at that if they think the stock is cheap. They're essentially buying back over 10% of their outstanding shares on an annualized basis. The new CEO, Alex Chris, we can't really judge his performance yet. He just started at the beginning of the fourth quarter, so it's still very early. He recently went on CNBC and said, "We're going to shock the world with our results." So in a couple weeks, we'll get to see what that means. But this is a stock that I've been building a position in over the past few months at the current price levels, and I'm really kind of excited to see where it goes over the next few years. Tyler?
So I'm looking at an old a company I've followed for a very long time. Never quite ever bought it, mostly because it's in the oil and gas patch. And when I really started to get interested in it was like 2015, 2016 is when the market was in the tank. But we're at a very different place in the oil market today. And so I've been looking again at Helmerich and Payne. Ticker is HP. For those not totally familiar, Helmerich and Payne owns land rigs, the rigs that are used basically in Texas, in the Pennsylvania area, the Marcellus Shale, and basically anywhere else in the United States on land. That versus like offshore drillers. So these are the rigs that do shale drilling, the ones that we are the new modern ones that can drill down several miles, turn a corner, go another couple more miles, and then go up and down a couple meters to stay within a layer of rock. The technology that they've been doing these things is it's absolutely incredible. But the mechanics of this business is that as a rig owner, you lease them out to companies that need to do work. So Helmerich and Payne will lease out to Occidental Petroleum, ExxonMobil, Chevron, and basically anybody who needs to do a job. And you get day rates and you get performance bonuses based on how well you perform, like how efficient you drill the well, and things like that. One of the things that attracts me most to this business right now is that the industry, especially in the United States, looks so healthy right now. Most oil and gas producers these days are saying that they can basically break even, which means we can pay for all of our expenses we can pay for future drilling, and we can give some modest return to shareholders in forms of dividends or whatever, and pay all those cash coverage or pay all those like cash outflows at about $40 to $50 a barrel of oil, which is very impressive. Before the shale crash in 2014, that was closer to $80, $90. So lots of progress in terms of cost efficiency. At that low of a price, there's a lot of wiggle room. I know not everyone that's an oil investor is too impressed with $75 a barrel of oil, but that's healthy. Like that's a good profit that's enough to grow the business reasonably, and you don't have to take on a lot of debt to do it. And so with that in mind, it looks like service companies, the ones that are contracted out to pay this, are going to be in business for some time and going to be able to have a modicum of pricing power because the producers can afford to do it these days. Not everyone is going to be fighting for every penny available in the shale patch. And so with that in mind, Helmerich and Payne has some of the best rigs in the industry. They constantly are winning awards for most technologically advanced, some of the best operator. And then from a management perspective, they are good stewards of shareholder capital. I know I've said that before, but this was a company prior to the epic shale crash in 2014, 2015, that area. They had paid a growing dividend for 45 straight years. It was incredible. And obviously they had to cut it because things in the United States got so rough for so long for oil services companies. But they're back. Things are looking much more attractive. They have maintained a very good balance sheet, 17% debt to capital. That's a very low leverage ratio for almost any oil and gas business. And right now trades for about 1.3 times book value, about 8 times free cash flow, and has a dividend yield of 5.3%. Those are the kind of metrics that you get for a company. Like, for example, on a price to book basis, that's the cheapest it's been outside of COVID. And at a price to free cash flow ratio like that, you're basically saying that this business is going to contract very soon. But I think with the health of the shale patch, provided that we don't see some epic collapse in demand because of another pandemic or something like that, this looks like a business that, for the next couple of years is going to churn out a lot of cash, going to return a lot of cash to shareholders. And despite it's never going to be a 30 times earning stock, but at 8 times earning, you can make a reasonable return for quite a few years at that kind of rate.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.